Risk and position size. Welcome to the third lesson of our risk management course. Let's start by going over the content for today's lesson. As always, I like to begin with the why. Why does risk and position size matter, and how is this going to help you become better traders? Then we'll define risk as a concept per trade, and we'll go on to talk about how much to risk per trade. In this section, like with the previous stop loss course, I'm going to go over the pros and cons of the different strategies so you can fundamentally understand them and the difference between applying each one. Then we'll talk about how to actually calculate position size. We'll go over the formulas and the mathematics behind it. Despite there being tools online that can calculate this for you, you always want to understand the formulas you use so you can become more fluid traders. Finally, we'll put it all together and go over the key points of this lesson. Here are some disclaimers. Make sure to read over them carefully. Why risk and position size matter. Okay, now I'm going to show why stop losses alone are not enough. Let's take this scenario where we open a market short position for $1,500. And again, I'm using the exchange Femex because this is my preferred one. If you want to use them or try them out, there's a link in the description below. So we open a sell position. This is for 1,500 contracts. And we'll set a stop loss because remember, we know this is really important. And last time we determined the necessity of a stop loss if we ever want to successfully trade. So now we know that we won't be liquidated, whatever happens, because we have a stop loss in place. Let's confirm this and see what happens. So we've entered our position and you can see our stop loss up there at 15,900. Now this is a short position, so we make money as the price goes down, if it goes down. So let's start by moving our stop loss down a little bit. And look at this, that's a nice technical invalidation for a stop loss. We're assuming that a top has been made over here, and this was just a deviation and the price will continue going down. Great, we're not getting liquidated, we have a stop loss in place, but what more is there to it? How much money will we lose if we hit this stop loss? How many times in a row can we afford to hit this stop loss and still be profitable? If I set a profit target, say, over here, we use this. Femex makes it very easy to set profit targets. Just click take profit and then let's say 25%. Confirm, really easy. Now, let's take this down to here. Which one of these will make more money? This loss or this profit target? What's the ratio like between these two? If I keep doing this 100 times in a row, will I make money? It's not enough to just make money once. When we look at this, we need to look at the big picture. What's going to happen if we keep doing this time and time again? That's why defining our risk, understanding not just what we stand to lose in this one trade, but what we stand to lose after hundreds of these trades in a row is extremely important. This leaves us with the key point that every single trade needs to be entered with predetermined risk. This is what separates us from gamblers. This is the difference between trading and gambling. When we trade, we really take the time to calculate our risk and the overarching picture behind the trades we take, and we make sure that long term, the odds are in our favor. How much to risk per trade? We'll begin by going over the key principles. The first of which is that risk and reward are correlated. This means that if you increase risk, you increase reward. If you decrease risk, you decrease reward. There are exceptions to this relationship, but they are extremely rare, and when they are found, they only last a limited amount of time. Our next key principle builds upon this, and that is the concept of how much we risk. If you risk too much, you stand to lose everything you have. Because if you take multiple back-to-back losses where you're risking a large amount of money relative to your total portfolio, then eventually you will lose most of your money. If you remember previously, we had charts which demonstrated how difficult it is to make back money you lose. However, if we want to make a decent amount of money when it comes to trading, we can't just completely eliminate risk. Because when we risk too little, well, then we'll never make enough money because our reward will also be proportionally reduced. So it's about finding that sweet spot between risking too much and risking too little. I'm about to now give you two answers as to how you can overcome this. So when it comes to how much to risk per trade, the simple answer is that you should risk 2 to 4% of your portfolio. If you want to be on the lower end of risk, pick 2%. If you want to take a normal amount of risk, pick 3%. And if you want to be on the upper end, naturally, you're going to want to pick 4%. And this is the simple answer. So you can assume that if you stay within this range and you have a decent system, that you are somewhat managing your risk. Combine this with the lesson we learned previously, which is stop losses, and what I'm about to tell you about position sizes, and you have everything you need to keep your risk to enough of a degree, more than 90% of people, under control. Now, for those who don't quite understand what 2 to 4% of total portfolio means, I'm just going to give a quick example. So total portfolio is the entire bankroll which you have. It is all the money you use to trade with. So in an example where, say, our total portfolio is $10,000, that means the money we use for trading, the money we've allocated for the specific purpose of trading is $10,000, then per trade, our risk needs to be $200 to $400. We're going to approach the question again now, but this time I'm going to give you a more detailed, more complex answer. And the advantage of the complex answer is that if you truly want to master trading, you need to be able to manipulate all parameters. And to do so, just like with stop losses, where there were multiple pros and cons for different types, I'm going to try explain the same thing again, only this time in the context of risk. The first type of risk we're going to look at is relative size. Now, relative size means using a fixed percentage. Much like we had in the simple answer, we used 2 to 4%. Now, you can pick any percentage amount you want to use, and using that as a means of setting a stop loss has certain pros and cons. The first pro is that when you're using a percentage, it's always relative to your portfolio size. A bigger portfolio means you're risking more in absolute terms, which means you make more money. Now, a big con is that the same is true the other way round, because as your portfolio gets bigger, you stand to lose more money. 3% of $10,000 would be $300. However, 3% of $100,000 would be $3,000. So even though your reward increases, so does your risk. There's another method that is often overlooked by traders, and this is using fixed size. Because traders like the idea of compound percentages, the way that percentages build upon each other, they tend to overlook using fixed size. Using an absolute value, that means you pick any whole number and not a percentage and use that consistently, has its pros. And that is, the biggest pro that comes with this is that as your portfolio grows, your downside gets limited significantly. If you take a scenario where you are a trader who is quite comfortable with the amount of money he's making trading. To use myself as an example, I no longer feel the need to significantly scale up my portfolio. I am very happy with how much money I make per trade, so I keep it at a fixed amount. Arbitrarily, let's say I trade a $100,000 portfolio. That means if I'm risking, say, 4% of that portfolio, I'm risking $4,000 per trade. I don't need to risk any more than $4,000 per trade to be happy with the returns I make. If I win a trade and say I make twice the amount I risked, which is $8,000, I'm very happy with that. So I don't need to scale that up any further. So as my portfolio grows, say I win a whole bunch of trades in a row, and now that 100,000 is worth 200,000, I'm still risking the same amount, which is that initial 4,000. Even if I lose, I'm now losing only 2% of my portfolio rather than losing what would be twice that given how much money I've gained. So this can be extremely useful for limiting downside as a portfolio grows when you're not after that exponential percentage growth. As I'm sure a lot of you will have been able to infer from my explanation, this comes with cons, and that is that because your downside is limited, so is your upside. You will always win the same amount regardless of how well your system does, so there is no exponential growth here. We just continually win a set amount of money. And also, if in the initial phases your portfolio doesn't do well, well, the opposite happens, because if your 100k shrinks down to 50k, suddenly that 4k is now 8% of your total portfolio. So it also accelerates your downside if you do not do well initially. Finally, we're going to discuss discretionary risk. Now, you'll see me use the word discretionary a lot throughout this course. And that is because as traders, as people trying to master an art, we need to eventually build towards being able to have some sort of instinct, some sort of experiential advantage over the rest. And this means with risk and every other element of our system, we should be able to naturally interpret what is best for different situations. And discretionary risk in this case means you have a good feel for the ebbs and flows of the market alongside data to back these feelings. And when you feel market sentiment changes, when you see certain changes in market structure on the charts, you will up and reduce your risk based on your past experience. And what this does is it tries to get your risk highest when you think you have the biggest edge in the market, and it reduces your risk when you think you have less of an edge in the market. If you know a certain trade you're about to take is a super high probability trade, then naturally you're going to want to increase your risk so you stand to win more in the example of this super high probability trade. So the pros of this, well, it's very easy to do. You simply decide how much you want to risk per trade. You don't have to stick to the exact same one every single time. And it also requires very little time and testing. By this, I mean your evidence that your discretion works is simply the fact that you are a profitable trader. If you have been making money for X years and you've been doing so in a sensible way, then you can somewhat trust your discretion, and that automatically becomes your data, so there's really not that much need to do extensive backtesting. Now this comes with major cons. I need to make this clear that discretionarily setting your risk is extremely difficult to do. Firstly, you are susceptible to your emotions more so than ever. If you do not trust yourself to separate your emotions from your trading, then you are probably going to end up destroying yourself over this decision. You only need to 1 time or 2 times risk more than you can afford to lose to completely wipe out years of progress with regards to trading. The other con is that if you don't have a solid understanding of mathematics, of the amount of risk you are actually taking on. This includes concepts we'll cover in the next lesson, like risk of ruin, like expectancy. If you don't have a thorough understanding of these, you are likely taking on a lot more risk than you think you are when you increase or decrease your risk. So there you have it. I have now given you 3 different methods which you can mix and match, just use one or use none of depending on what you like to determine your risk per trade. This leads us nicely into the last part of the course, which is calculating position size. Let's go over a very simple formula now to calculate position size. I know a lot of people struggle with these sorts of formulas, so I'm going to include an example as well so you can see how this applies in a real life scenario. The first relevant variable is position size. Now this is our final output, and here's where that goes. If you take a look at the exchange over here, Femex, this is what we use. You can see that under quantity, this is going to be our final output. Now here we put quantity in US dollars, so we need to make sure our final output is also in US dollars. Next variable is maximum risk. Remember, in the example we gave earlier, our maximum risk is, let's say, 3% of $10,000, so our max risk is $300. Then the next variable is entry price. Now, entry price is the price you're looking to buy or sell your asset at. In the context of the exchange, you can see that your limit price is where you enter this. So say you want to enter a position at $15,000. You can see over here we have $15,000. And our final variable is the exit price. The exit price in this context is our stop loss. This is exactly what price our stop loss is going to be placed at. So we're entering at $15,000. We're going to place our stop loss at $14,851. So how large should this position be? Well, we're going to put everything into our formula to now figure this out. The formula we put this all into is position size equals max risk over entry price minus exit price. And these are all we need to figure out how big our position size should be. So if we take a look, we have $300 over 15,000 minus 14,851. So this gives us our output of 2.0134. Now, if we go back to the exchange, we can see that the input quantity is in US dollars. So if I put that 2.01, you can't even put that 2 point anything. So if you put 2 in, immediately it's an order value of 0.001 BTC. So we need to translate this into US dollars. And that's very simple to do. We take our entry price, which was that $15,000, and then we multiply that by 2.0134. Once we get that, we get our final USD value output of 30,201. And now that we have our output, we go 30201, that's 30,201, and we click, put our entry price at the correct 15,000, and then we click buy. And you can see over here that our final check will be had once we click stop loss, input our stop loss of 14,851, and you can see here that the total value of BTC is 0.0202, and that roughly equals $300, so that is the correct estimated loss. And now we have a position ready with correctly managed risk to enter at $15,000. Now we're going to put it all together. Let's talk about the key takeaways from this lesson. The first one, which I want everyone to make sure they understand thoroughly, is that risk and reward are correlated. The more you're risking, the more you stand to win, and the less you're risking, the less you stand to win. This can be further extrapolated to assume that people that make disproportionate returns are often taking on disproportionate risk. There are small exceptions, but generally this is the case. For the next takeaway, I hope that by this point in this lesson, you've all understood that stop loss placement and position sizing are equally important. You cannot have one without the other and have it have any meaning. But alas, there is even more to risk management. Next lesson, we are going to talk about how to make sure our system is profitable. We're going to put our risk into the context of our profit and our win percentages to show you how you can figure out your expectancy. And then we'll go even beyond that to talk about risk of ruin. This is the chances of you going bust before your system has time to play out. Because remember, the upside is infinite, the downside is limited. Once our bankroll gets too small to make up our losses, then we are ruined. So let's learn how to minimize this risk of ruin. Thank you so much for tuning in to another lesson of my risk management course. I look forward to seeing all of you next week.